Hello everyone, welcome to this presentation of the right way to trade tops and bottoms. Welcome, my name is Stephen Primo. I'm the president and founder of Specialist Trading. If you're new to my educational presentations and webinars, I'd just like to firstly let it be known that we are all about educating you so that you can be the trader that empowers yourself, because we are an educational company first and foremost. In fact, that's our only goal, to educate you so that you can ultimately put the power back in your hands. It's our belief at Specialist Trading that the reason why most traders fail is because you're relying on someone or something else to make your trading decisions for you. Now think of it. Look at the way you trade personally. Do you go to a chat room or a trading room every day to find out what everyone else is trading? Do you listen to the trading gurus on TV and see what their picks for the day are? Or do you go to some signal service to find out what to buy and sell on a nightly basis? Well, we feel that that's the reason why most traders fail. And what we want to do is empower you with the knowledge and the insights and wisdom, as well as trading strategies, so that you can put the power back in your own hands. Now, I've been trading roughly 39 years. I started trading on the floor of the Pacific Stock Exchange. I was on the floor for 16 years. 9 of those years I was a specialist. A specialist was just one of those traders that made markets in stocks. I made markets in roughly 50 stocks on the floor. So if you wanted to buy or sell any of those particular issues, you had to go to the trader who specialized in those. I traded through the crash of 1987 and the bull market that followed. And so I know what works in terms of consistency, and I know what doesn't. And so that's what I do at Specialist Trading. I simply mentor and teach all of my students the things that I have found to hold a high level of consistency. Now today, I'm going to be teaching you a great entry technique. It's not a full-fledged strategy, but it's a great entry technique for trading tops and bottoms. I think you'll really be surprised how simple it is and how easy it is to be in sync with the overall market. But before we begin, we are required to show you this, so please take a moment to view our disclaimer. I'm going to show you a lot of performance results dealing with this particular entry technique, but please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. Once again, we are required to show you this. And as you're taking a brief moment to look at this, I would also like to take this time to invite each and every one of you to follow us on Twitter if you haven't done so already. There's our handle right there. You may want to copy that down at SPCLSTTRADG. I post new and updated information on a daily basis, anywhere from little daily bits of wisdom to actual signals that some of our strategies have generated. So feel free to join us. It is rather limited, but there's a lot of information there, and you can also find out more about what we do and everything involved with specialist trading. Okay, now as I stated earlier, we are an educational company. Our only goal is to teach you. You notice as we see here, it doesn't say my goal is to trade for you. I want you to be in charge of that. But my goal is to teach you the things that have shown a certain level of consistency so you can be trading with the specialist edge. This is the same edge that was able to turn my trading around. This is the same edge that I try to instill into all my members and all my students, okay? Now, this is going to be a class, so I kindly ask that if you have any questions, please wait till the very end of the presentation. I promise I'll get to each and every one of them in just about 25 minutes from now. The only question I will answer is the most common one, and that is this being recorded? Yes, it is. We record all of our educational webinars, so if you have to leave early or if you're having some technical difficulties, we do have a copy of this. Simply contact Pro Trader Strategies. They're my sister site, and they will send you a link to all of our recordings, or this particular one that you're missing if you happen to be. All right, so why don't we begin? And I'm going to start out by sharing with you how most people trade tops and bottoms. And I say this from firsthand experience because this is the way I was trained to trade tops and bottoms, and I think this is the way most people do trade them. And I'm going to start out also by showing you some older charts just for educational purposes, and then as we go forward, I'll show you charts that were as recent as the last couple of weeks, okay? All right, so let's start out with stocks for all you stock traders out there. And let's look at this older chart of Cat Tractor, okay? Now, if one wants to trade tops and bottoms, what the majority of people use is some type of tool or indicator, something that tells them that the market is overbought or oversold. In other words, it's too high or it's too low. So if it's in the so-called overbought area, obviously you want to sell it, and it's in the so-called oversold area, obviously you want to buy it. Now, there are many tools you can use for this, either something you've created yourself, oscillators work fine, or it can even be someone on TV telling you the particular market is overbought or oversold. In this instance, all I've plotted is your standard slow stochastic indicator. Now, I didn't edit it. I don't even know the actual formula for it, so don't ask me what it's, if I changed anything. It's just the standard default slow stochastics. Now, as we see here, this top green line, I should say blue line, is the overbought threshold. So anything above there would deem that the market is too high. Whereas anything below this lower threshold, which is set at 20, I believe, is to be oversold or too low, okay? So the way conventional wisdom tells us is that when we get into these so-called areas, for example, when we got into the so-called oversold area and these lines crossed, that's your indication to buy. And as we see here, well, the stock went up and went up very well. Now, as you're holding it, you wait for this tool or indicator, or remember, any indicator, it doesn't matter. I don't want you to get set and think that, well, I have to use this tool because this is the only one that Steve uses. No, it can be any oscillator, any tool that tells you the market is overbought, oversold. I just happen to use this one. But as we see now that we are in the so-called overbought area, well, now these lines cross again, so that's your indication to sell. So you sell your long, and now if you're a more aggressive trader, you'd go short. And this is working out very nicely as well. So you're doing very well trading this way of tops and bottoms. Now, once again, we see that the tool goes down into the oversold area, and when the lines cross, well, this is your indication to buy. So you cover your short, you've got a very nice profit. And at this time, you think you're going to be retiring in about 6 months because it's just too easy, and you jump back in and buy Cat Tractor again. But this time when you buy, it doesn't go up, okay? That's okay. If we look at the indicator again, well, we're still in the so-called oversold. So if it was oversold before, it's got to be more oversold now, right? So we do what's called doubling up, and we buy some more. So now it doesn't need to go up as much. It can actually go up less, and we'll still break even and possibly make more money. So we double up, and it goes up a little, but not enough to get us out. And now we even triple up because now it's much, much lower. So now we've invested a lot in this. We've pretty much given back everything we made, but that's okay because it'll probably go up. After all, it's been an oversold for a long time, right? So you triple up, and it never goes up. In fact, it goes lower and lower until ultimately you've lost everything you made in the first couple of trades, and now you're in the negative column, okay? Does this look familiar to anybody? Now, this doesn't just happen with stocks. You can also see this happening with futures. Let's look at an older example of the E-mini S&P. As we look here, we have a 5-minute chart. Before we were looking at a daily chart of stocks. Now we're looking at a 5-minute chart of the E-mini. We have the same slow stochastic plotted, haven't changed anything, haven't edited or altered the standard default settings. We still have the same overbought, oversold conditions. And so, as we can see here, when these lines crossed in the so-called overbought area, we sold, and it worked great. Okay, so we're short the E-mini futures on a 5-minute time frame. When the indicator took us down to the oversold area, the lines cross, and now we cover our short and go long. And it's working great. We're long, and it goes back up. So this is working just perfectly. You thought, well, maybe I shouldn't be trading stocks. Maybe this works much better trading intraday futures. So the indicator goes back up into the so-called overbought area. The lines cross, and so now we sell. We have a nice profit again, and now we go short, and we think, well, this is what I should have been trading. I should have been trading intraday because this works much better. So you sell, and it doesn't go down again. In fact, it goes up a little higher, so you double up. You triple up, and once again, you've given everything back that you made on the first couple of trades, okay? Now, this doesn't just happen intraday trading. We can also see this in the Forex currency pairs. In fact, it's my opinion that you'll actually see it more in the currency pairs because they trend so strongly. If we look at this older example of the Swiss franc, we see here that the currency pair is going, higher to sideways, but it's in the so-called overbought area. So obviously it's got to go lower, right? I mean, that's what we're always taught. If something is too high, it's got to come lower. So you decide to sell. And it goes sideways. It doesn't really go up higher, but then it goes even higher. So now you've got to sell some more and some more. So unlike the other examples, you don't even have a winning trade here. Each and every one of your trades is a loser. At this point, you've probably blown out your entire account, all right? I'm telling you this, once again, not to be condescending or arrogant. I'm telling you because this is the way I was trained to trade, and I realized that this style of trading, trying to pick tops and bottoms, will work until it doesn't work. And then it turns into a disaster. You give everything back. How do I know this? Well, because during the crash of 1987, when I was on the floor, I tried to trade with this method, and I'm sure you can figure out what happened during that day in 1987. So my mentor saw how much I was struggling on the floor trying to trade this way. So I was lucky enough to have a couple of teachers myself. These were specialists who had been on the floor some 40, 50 years individually, and they saw how much I was struggling, and they shared with me a concept that really changed my way of thinking. And this is the concept I want to share with you today. What they said was, there is no such thing as overbought or oversold. All right, I'm going to repeat that again because that's how important it is. You may even want to write this down. There is no such thing as overbought or oversold. Now, I had a very difficult time, comprehending that, because after all, I had been trained that when stocks got too high, you had to sell them, and when they got too low and too oversold, you had to buy them. That's where the value was, okay? But then they shared with me this concept. They said, okay, Steve, if that works, go back and look at some stocks and just use a common overbought, oversold tool and look how long something can be overbought. Do you have enough money to keep you in that to continue to sell and sell and sell as the stock or whatever you're trading goes higher and higher? As well, you can look at something that is tremendously oversold. It keeps going lower and lower and lower. Do you have the wherewithal to stay in it and to hold on while you're losing more and more and more as it keeps going lower and lower? Because there really is no such thing as to how high or how low things will go. We've seen trends or things be in the so-called overbought area for weeks, months, even years. We've also seen the same with oversold conditions, weeks, months, years. In fact, we've even seen stocks go down to nothing, to zero. Remember Enron. So you have to get this concept straight with yourself, that there really is no such thing as overbought, oversold. It will work just like gambling in Las Vegas. In other words, if you're going to the slot machines, every once in a while they will give you a winner because it gives you this false sense of security thinking that you're doing all right. But over time, they're designed to take your money away. They're designed or to be, the worst odds for any type of gambler. It's the same thing with trading overbought or oversold conditions. Over time, you really will have nothing to show for it. So that's the concept I want to get straight before I teach you what this entry technique is. So once I finally grasped that concept and I was willing to accept it, I thought, well, what is the correct way to trade tops and bottoms? After all, that's the title of this presentation. So the right way to trade tops and bottoms, what my mentors taught me, is to simply go with them. So what do we mean by going with them? Well, this is the entry technique I'm going to be sharing with you today. Once again, you can start using this as early as tomorrow, but I'd like you to just experiment with it a little. And I know a lot of you are going to say, well, Steve, God, this is great, but where do I exit? Where do I place my stop? Well, those were all important pieces of the puzzle. Today, we're just going to be telling you about the entry point because it is the most important. If you've been trading for a while, you would be, I'm sure very inclined to figure out where you want to place your stop, maybe against the last short-term high or short-term low, and then just whatever your risk is, just double it, and that would be your exit. That's a very simple way to trade it. Okay, so let's go back and look at that example of Caterpillar Tractor. And for those of you who may have entered a little bit late to the presentation, remember, if you have any questions, kindly wait till the end of the presentation and I'll answer all of them. Okay, let's hold off for any questions and many times your question will be answered on the next slide. Okay, so let's look at Cat Tractor again. This is where we had a couple of winners and then we gave everything back. So what is the correct way to trade this? Or how would you trade this correctly? Well, what my mentors taught me is before you trade anything, regardless of the strategy and regardless of the market, you have to add one tool. And this is the 50-period moving average. Then you ask yourself, once you've applied this, before you've even entered, you ask yourself, where is price in relation to that 50-period moving average? Okay, I'll repeat that again. Ask yourself, where is price in relation to that 50-period moving average? If price is above, then we will only be buyers, regardless of what technique or what strategy we're applying. But as in this case, if price is below, we're only going to be sellers. So therefore, if we're only selling, we're not concerned with trying to pick a bottom, right? Because a bottom would mean we're trying to buy at the bottom. We're not concerned with buying anything. We're only going to be concerned with selling. All right, so now we know what side to be on, okay? We know how we're going to be playing this technique. Which brings us now to the slow stochastic. And once again, it doesn't matter if we're using the stochastic. It can be any indicator that tells you when something is overbought or oversold. So I don't want you to get set on thinking that, well, I have to use this tool. What was that tool Steve had? Anything that says the market is overbought or oversold, because we're going to exploit that tool, because we now know, we've come to grips with the fact that there is no such thing as overbought or oversold. So we're going to exploit what all the other people are making the decisions based off of. All right, so since we're only going to be selling cat tractor, we want to locate all of the so-called oversold conditions, which we have circled in red here. You see when we went below that oversold threshold. So now that we've located those, we want to identify all of the short-term bottoms that were created in the stock, all right, the little bottoms that were created, but they had to be created when you were oversold, all right, because that's where people thought we were bottoming out. And if we look, these are all the bottoms that were created when we were oversold. Now, sure, there were some bottoms here and some bottoms here, but they were not in the so-called oversold area. We have to be below this threshold. And what our entry technique is simply, once we trade below that so-called low, 1 or 2 ticks, 1 or 2 cents, we sell. And now before, where we had 1 or 2 good trades and then we gave everything back, now we have nothing but winners. See how simple this is? Because we're on the right side because of the 50-period moving average, and we are exploiting oversold conditions. Why? Because there is no such thing as oversold. It doesn't exist. It's a myth. Let's look at that example in the 5-minute chart of the E-mini. Okay, before we had a couple of good trades, then we gave everything back. Well, what's the first thing we do before we even pull the trigger? We apply the 50-period moving average and we ask ourselves, where is price in relation to the 50-period moving average? Price is above. If price is above, are we going to be selling? Absolutely not. We're only going to be a buyer. So this means we will not be trying to pick a top, because a top would mean that we're trying to sell into this. We are going to be in sync with the overall trend. That means we're only going to be a buyer. So if we're buying, then we're going to exploit the so-called overbought conditions circled in green. All right, so once you know when you're in the overbought area, you want to identify all of the tops that were created right here. And we know that once we trade 1 or 2 ticks or 1 or 2 cents above those levels, that's our buy scenario. That's our entry technique. And now once again, before, where we had a couple of losers, or I should say a couple of winners, and then followed by a number of losers, now we have nothing but winners. Why? Because we are in sync with the overall trend. That's the 50-period moving average telling us what the overall trend is. And we are exploiting overbought conditions, because there is no such thing as overbought. Let's go to the currency pairs. All right. Before we do anything, we add the 50-period moving average. We ask ourselves, where is price in relation to the 50-period moving average? Price is above. So before, what were we doing with the currency pairs? Remember with the Swiss franc, we were just selling, and it kept going higher and higher and higher. We probably blew out our entire account. Now, looking at this, look how simple it is. We know that we should have never been selling. We should only have been buying, because we've been above the 50-period moving average the entire time. You see how this simple rule will save you so much by getting you in sync with the overall trend. Doesn't cost anything. You can start applying it right now. In fact, go back and see on your last 10 or 20 trades how much this could have helped you. In fact, I can almost guarantee you that the majority of times you lost money was because you were out of sync with this simple rule. All right, so price is above the 50-period moving average. That means we're going to be a buyer. That means we're going to exploit where all the people thought we were up too high, the so-called overbought areas, right here. And once we've located where they are, we're simply going to identify the tops that were created. And by tops, we mean where you make a high, a higher high, then a lower high, another higher high, lower high. See how those tops, we kind of go and roll over, go and roll over. Every time one of those was made a higher high and then it went lower, in a so-called overbought condition, that is our entry to buy once you trade 1 or 2 pips above. Now, instead of having 3 or 4 losing trades, we have about 5 or 6 winning trades. See, trading is simple when you are in sync with the overall trend and you are trading with the flow, okay? We're not giving in to concepts that actually don't work or don't have any consistency to them. All right, so that is the basic concept I want to share with you. Now let's look at some more examples, some more current or recent examples coming into this month. All right, let's start off with stocks once again. As we look at this chart in AFL, we see here that a couple of months ago it was below the 50-period moving average, so you would have been a seller, but you see we never got in the so-called oversold area until we went above in the overbought, and that's when price started to coincide being above the 50. So once we came into roughly this month right here of being above the 50, we know that we're buyers because we're above the 50-period moving average. That means we're going to exploit the so-called overbought conditions. And we just simply identify the tops, and once we trade 1 or 2 cents above, that's our buy initiation area, okay? Now I always tell my students, if you're going to be trading this technique, you usually have the biggest bang for your buck on the very first setup. You know, not getting in here, but getting in right the very first time you cross above the 50. So as you purchased here, roughly around 60, well, that's about 9 points in the next couple of months. All right, look at VLO coming into July here. Now we're oscillating above and below the 50, but at this point, coming into May, we're obviously below the 50-period moving average, and we stay that entire time below the 50 all the way coming into the second week in July. All right, so what does this tell us? It tells us we're not going to buy VLO at all. We're only going to be sellers. Okay, so since we're selling, we locate the so-called oversold areas. We identify the bottoms that were created. And once we trade 1 or 2 ticks, we could sell short the stock. If we don't have the capital to sell short a stock, we can buy puts. And had you taken that very first signal right here and gone short around 58, well, the stock went down over 10 points coming into the second week of July. How about Triple L? Well, the only people I feel that would have lost money trading this were people trying to pick a top. But people would say, but I don't understand. Look how long it's been overbought. This is what I'm trying to instill in all my students and members in all my webinars. There is no such thing as overbought. So don't get caught in that trap trying to trade tops and bottoms. Once again, I know this from experience. I'm not just relaying concepts I've heard about. I had a terrible time trying to trade this way, and I almost blew out my entire account trading this way. So trust me, take it from someone who's been there before. There's no consistency in trading this way. So if we see that the price is above the 50-period moving average, well, then we want to be a buyer and exploit the so-called overbought conditions. All right, we simply identify all of the tops, and had we taken this very first setup here about 125, well, we went up 25 points coming into the first week of July. All right, I realize this is expensive stock, but you could have purchased call options or some type of call spread, something like that. Let's look at HRB and then coming into May. Now, obviously, some news came out where we gapped down well below here, but look at, we were below the 50-period moving average for nearly 4 or 5 days here. So this gave us plenty of warning telling us that you shouldn't be long this stock. So even though a lot of people say, well, Steve, news can, hamper that whole theory of the 50-period moving average, well, you're right. I mean, sure, nothing works 100% of the time. But trust me, for someone who's been using this for so long, it has saved me a lot of times by getting me on the right side. So we knew well in advance not to be long HRB well before we gapped down. And we're only going to be a seller, so all we have to do is exploit the so-called oversold area. And as we see here, we have been oversold from March all the way into May, coming into July, or June, I should say. So how long, if you had purchased here, how long could you hold on to being long, or how long could you continue to buy more? It's much better to simply use that 50-period moving average, exploit the so-called oversold conditions, look at where the bottoms were created, and as you sold right here at roughly 25, 26, you had a nice 6 or 7 points in the next couple of months to the downside. How about CCI? Once again, coming into July, we're above the 50-period moving average. We identify where the so-called overbought conditions were, and then we just have to locate the tops, and we buy once we trade 1 or 2 cents above. Had you taken the first buy set up here at 88, well, the stock went up nearly 10 points coming into July. AGN oscillated above and below the 50, but at this point right here, we're well below the 50-period moving average, and that coincides with an oversold condition here. So we simply want to identify them and then locate the bottoms. And had you taken this very first sell, you would have had a very nice awakening this 2 days later to see that the stock gapped down roughly about 20 points. Now you could have gotten short with puts or some type of a short spread here, roughly at 260, and the stock was trading 60 points lower in May. Now, a lot of people say, well, what happens when the trend changes? Well, you just change with the trend. All right, as we look here at this older chart of UPS, we see here that initially we were below the 50, so that means we were a seller. But once we had consecutive closes above the 50, we simply change our tune and become a buyer. See, we're just altering and we're changing and adapting with the conditions of the market. We're not trying to tell the market it's gone high enough and don't go any higher because I'm selling you, or don't go any lower because I'm buying you. We don't care how low it goes because we're in sync with it. All right, so when we were below the 50, we were sellers, so we exploited the so-called oversold areas. We identified the bottoms, and we could have sold here at roughly 95, 96, going down another 5 to 7 points. Now, once we changed, well, now we're a buyer. We simply exploit the so-called overbought conditions, and you could have gone long roughly about 98, up another 7 or 8 points. And here's Netflix. Now, a little while ago in June, coming into July, Netflix had a real strong move to the downside. A lot of people were caught off guard by that, but we weren't. We knew here that in the middle of June, we had consecutive closes below the 50-period moving average. Originally, we were above the 50-period moving average, and we were in the so-called overbought area. So there should have been a setup here, but only if we had traded above this high. You see that? Because this was the high that was created in the overbought area, but we never traded above that, so this kept us out of trouble. We didn't get long something that immediately went down. So once we went into the so-called oversold area and below the 50, we just changed our direction and turned into a seller. Now here was a bottom that was created. You could have gotten short right here, roughly around 93, and the stock went down about 8 or 9 points in the next week. Let's look at see how this works in the E-mini S&P if we're looking at intraday charts. Let's start out with a daily chart just to show you that it really doesn't matter what time frame. Coming into March, April, and May here, we were above the 50-period moving average. And look how long we were overbought. We were overbought 1, 2, 3 months. Okay, if you've been trying to sell the market, you would have lost a lot of money. But unfortunately, this is the way 99% of people trade. If you simply follow the 50-period moving average, you'll know that you're in sync now by simply buying above the 50. So we no longer have to use this as a point of selling reference. We use it as a point of buying reference because we're going to exploit it. So once we trade above there, well, we're simply going to look and find out where the tops were, and those were our points of entry. Look how well you would have done buying right here at the very first instance in March all the way up. Let's go to a 5-minute time frame, okay? Because nothing changes because we go to a smaller time frame. Now we're looking at a 5-minute chart of the E-mini, okay? Where we gapped up above the 50-period moving average. So the same rules apply. Since we gapped up, we're looking at overbought conditions, and all we have to do is buy 1 or 2 ticks above. Had you purchased on this very first scenario right here at the 2068, well, that's about 10 points or $500 per contract if you had held to the end of the day. We can look at what happened just a couple of weeks ago in July here. We gapped up above the 50-period moving average on a 10-minute chart. We used the same reference point. Look at how long we were overbought. Had you tried to sell anywhere here, you would have lost a lot of money, but all you have to do is simply be in sync with the market. And had you bought here, well, you would have had a very nice day, roughly buying around 21.15. Had you exited on the day, you would have made about 5 points. But if you carried it over for the next day, well, there was another 10 points you could have gained on the next day's opening. And then lastly, let's look at the Forex markets. Once again, because we change markets, because we change time frames, absolutely nothing changes. We don't have to change or alter the rules for this technique. All we have to do is simply apply it, okay? So, as we look here at a weekly chart, now we've looked at 5-minute, 10-minute charts, we've looked at daily bars. Let's look at weekly charts now, the Canadian dollar, going all the way back to July and August of 2014, roughly 2 years ago. Where is price in relation to the 50-period moving average? Price is above, so we're not going to sell the Canadian dollar if we're trading it on a weekly time frame. We're only going to be a buyer. So we locate the so-called overbought areas, and look how high the Canadian dollar went simply because we used this entry technique. Now, once again, remember, this is just an entry technique. We're not going to share stop placement and exit placement, but I'm sure if you've been trading for some while, you'd be able to find out where to place a stop. I mean, the last short-term low would suffice as a nice stop, and you can simply double that risk to use at your exit point. It's up to you. Remember, our goal, as I stated in the first 30 seconds of this presentation, our goal is to put you back in charge of your trading. We feel the number one sin most traders make is by relying and putting too much reliance on someone else to make their trading decisions for them. I mean, can you imagine, someone in an airplane, flying hundreds of people saying, "Well, tell me what you think I should do. Where should I land, or how should I take off?" I mean, they're in total charge. They know, they've studied, they've researched, they have the discipline. Can you imagine a brain surgeon asking someone, say, "What should I do here in the middle of the operation? What do you think I should do?" But that's the way you trade. That's the way the majority of people trade, myself included. And you shouldn't. It's your hard-earned money. You shouldn't be asking other people how to spend it. You should be in charge. So I'm sharing with you a great technique to put you back in charge of your own trading. Now, that was a weekly time frame. We can go to a daily time frame, okay? If I go back and backtrack, once again, we see here that this last couple of days or weeks here, we started to head lower in the Canadian dollar. So if you weren't trading on a weekly basis, well, here's where we were heading lower on the daily basis. As we see right here, we crossed below the 50. So now we're a seller on a smaller time frame. We use the same technique. So it wouldn't matter what time frame we're using. Just trade the time frame that your chart is. You don't have to look at multiple time frames. Why overcomplicate your trading? I don't subscribe to that technique, because the only thing it does is keep me out of good trades. I only trade the chart I'm looking at. Whatever the signal was and whatever chart that was, that's all I'm worried about. I don't care about what a higher time frame is telling me. All right, so here's what I want to leave you with before we go to questions and answers. Please, never ever try to pick tops and bottoms. Take it from someone who's been there. Take it from someone who tried to pick a bottom during the crash of 1987. It just doesn't work. Sure, you may have some nice winning trades and some winners every once in a while that will make you feel like, I don't know what this guy Steve Primo is talking about. It really does work. But over time, it's just like the slot machines. They're designed to give you this false sense of security, thinking that you're doing okay. But over time, you'll actually have nothing to show for it. It's much better if you simply go with the flow. Why? Because there is no such thing as overbought, oversold. Go back and look at stocks, futures, currency pairs. You've seen things overbought, oversold. I just showed you some charts here that have been overbought for months. Same thing as being oversold for months. So if you tried to hold on to a position, you would have lost a lot of money. It's much better to simply use the technique I share with you today to be in sync with the overall markets. So as we close here, I want you to ask yourself, and ask yourself honestly, do you think this edge could have helped your trading this past year? Now, once again, I'm not telling you how to trade. I'm not saying this is the way you have to start trading tomorrow. But even if you had just used that 50-period moving average, don't you think that could have helped your trading a bit? I mean, I dare you to go back and look at your last 10, 20 trades. As I said before, I can almost guarantee that the losers you had going back 10 to 20 trades was because you were buying above, or I should say buying below the 50-period moving average and selling above the 50. You should be doing the opposite. But for some reason, we're all trained the exact opposite way. We're told to sell something that's high, and it continues to go higher and higher. And we're told to buy something that's low, and then most of the times it continues to go lower and lower. Now, I want to tell you about our special attendee discount today for all the people attending today. I'd like to offer you a great package we have. This is our Secrets of a Stock Exchange Specialist training sessions. Now, some years ago, I was asked to be the head speaker at a conference in Denver, where I spoke for roughly 3 hours, and I talked about things just as I talked about today, but entirely different. I didn't even talk about what I share with you today. I talked about many more high probability trading edges. I also talked about which indicators to use and which ones, more importantly, not to use. I went into detail about the difference between a system versus a strategy, but I think the best thing on this 3-hour video is that I gave the complete rules to one of our best in terms of consistency, one of our most consistent pullback strategies. In fact, let me show you some recent signals that were generated for our course members using this particular strategy. Now, this is a pullback strategy, so it's a lot different from what I just shared with you today. What I really kind of shared with you today was a point of entry for a breakout above a short-term high or a breakdown below a short-term low. This is entirely different. This is looking to find out what the overall trend is and then looking to buy at a much lower price within the overall trend. Now, as we see here with CVX, it looked as if it was rolling over. In fact, it had made a high and then made a smaller high. Most people would thought it was rolling over, but strategy number one, all of the rules that are contained within this 3-hour video, deemed that this was actually a buy signal. So our members could have gone long CVX here and in the next 3 or 4 weeks had a nice 10-point gain. That's a pullback trade. It works with going short as well. Now, if we look here at PRGO, a lot of people thought that, well, this was a nice support here. As we see here, we made a double bottom. There's probably some good news coming out, so we should look to buy this stuff. But strategy number one said that, no, this was just still in a downtrend, and all we were doing, we're pulling back. And that actually generated a sell signal on this day. Had you gone short, well, that was 35 points in the next couple of weeks to the downside. You can also apply this to futures. Here's a 10-minute chart of the E-mini S&P. This also looked as if it was rolling over, but the strategy generated a buy signal, and the E-mini futures went up 12 points or $600 per contract in the next couple of hours. Lastly, we look at a weekly chart of the euro-yen. All right, now we had a really nice sell signal here, and a lot of people thought, well, that was nice, but it's most likely going to go higher now. But as you can see, it generated another sell signal, and it generated roughly about 1,000 pips in just roughly the first 2 or 3 months of this year, 2016. The same rule applied to currency pairs, futures, stocks. It does not matter what time frame. It doesn't matter what direction. Now, the beauty is, once again, unlike today, I give all of the entries, all of the stop placements, all the exits, as well as all the rules for money management in our 3-hour Secrets of a Stock Exchange Specialist video seminar. I think the best thing about this is that you also become a student of mine with lifetime correspondence. You can be corresponding with me through email whenever you'd like. So if you have a question about any of the things involved in this 3-hour training session, anything involved with strategy number one, you can always email me and I'll get back to you ASAP and answer any question you may have. So this is simply an online course. We send you the link and you can be up and running immediately. It's 3 hours of trading techniques plus a full strategy, all the rules to one of our most consistent pullback strategies. Now, once again, my sister site, Pro Trader Strategies, they have this marketed on their website for close to $1,000. That's how much information is jam-packed in this course. We are discounting that today down to $37. I don't think you can really beat all the information that's provided in this for only $37. It's a fantastic deal. It's probably less than you spent commission-wise today trading in and out of stocks or whatever you're trading. Now, here's how to take advantage of this because it's only going to last for the next couple of days. Contact Pro Trader Strategies. Once again, there's their email address, trading@protraderstrategies.com. You can also call them directly at the number given right there on the screen. And as you see the link below, you can also use that link to go directly to the $37 deal sign-up page. You can take advantage of that short-term discount. Now, that's not a live link. You'd have to copy and paste that onto your browser as you see there. But if you look in the chat box on your far right-hand corner, they have posted a live link. So all you have to do is click that on. It will automatically take you to the $37 sign-up page, okay? But please, once again, that's only going to last for the next couple of days, 48 hours, and then it goes back to $997. So I don't think you can get this much information for such an inexpensive price. In fact, I don't even think you can go out for dinner at less than 50 or 75 bucks these days. So for 37, you're getting tons of information that will last you a lifetime. I'm going to leave this information on the screen, and I'm going to open up the question and answer box. And I want to thank you all for waiting to ask any questions. And let's see here. What's the first question? Steve, why do you need the stochastics? Wouldn't it work just as well without it? Well, this is a good question. The reason why we're using stochastics is because, remember, we want to go off of that concept that there is no such thing as overbought or oversold. And once you fully understand that there's no such thing as overbought or oversold, then you want to exploit it because that's where things will really start to move in your favor. See, because if we just picked any short-term low, it might work out well, but the lows that were created in the so-called overbought, oversold area, these are lows and highs are the ones that have the most significance because that's where the buyers or sellers came in. And they really banked on that being the low. Because why? It was in a so-called oversold or overbought area if you're looking at short-term highs. Well, we know that most of the time they're not going to hold. And then what are these people going to do? All the people that bought there are going to say, oh my gosh, well, now all my stops are going to go off, or I'm going to sell at the market. So you're going to get a lot of energy behind that entry point. So that's why we use some type of an overbought or oversold type of indicator, because that way we're going to exploit that. Because most people bank on that. I know I used to, and the minute I would get stopped out or it would go below where I bought, where I thought the low was, I'd have to sell really quickly, and it turned into a kind of a snowball effect. So you want to take advantage of that. What you want to do is you want to exploit that. Okay? I hope that makes sense. Good. Okay, good. It makes sense. That's a good question, though. Any more questions? Remember, in this 3-hour video presentation, I give a lot more techniques that are entirely different, but just as powerful as the one I share with you today. In addition to that, I give you a full-fledged strategy, which comes with all the rules, stop placement, exits, and money management. So I don't think you can get a better deal for $37. So take advantage of that while you can, okay? Now, once again, if you had, I see some people may have had technical difficulties, or they had to leave early, or if you came in late. Pro Trader Strategies has links to this recording, but contact them. But please remember that discount will only last for the next couple of days. So don't sit on that and wait for a week to ask for a recording, because you want to take advantage of that $37 deal before it goes back up to $1,000. Next question. Kent asks, does this technique presented today work for day trading? Sure it does, Kent. I just showed you a number of E-mini futures charts, 5-minute chart, 10-minute chart, and you can just as easily transfer that over to day trading stocks. I'm sure you could use that. Let's say Netflix. When Netflix was going straight down, if you were looking at a 10-minute chart of that, you could have done just as well. Or if you're looking at a stock that's going straight up, when Yahoo was going straight up before the buyout announcement, or you could have used that to intraday trade that. So it doesn't really matter. We know we have a number of students who use this just for intraday trading. They apply it to currency pair intraday trading, stock, and futures. So yes, it works just as well. Okay? But remember, the technique I shared with you today was simply an entry technique. If you want to find out more about exiting or stop placement, that's in the $37 course. Okay? Remember, Pro Trader Strategies are the people to talk to. They handle all the marketing of my courses and all the sales. They have a great special for the next 48 hours. It's just going to be $37, okay? So it's a great deal. Please take advantage of that. I think the best thing about that, in addition to a full-fledged strategy and 3 hours worth of more techniques, is that you're my student now, and I can personally mentor you in terms of corresponding with you through email. Anytime you like, if you have a question, you can contact me. So this is a great deal for such a small price, okay? All right, so if that's the questions we have, we're going to just leave this information on the screen here. Once again, I want to thank you so much for attending today. I hope you got something out of this. I hope you got a little education, because remember, we are an educational company, and that's what our only goal is, to educate you so that you can put the power back in your hands. It's my belief that that's the only way you will become consistent, not by going to a signal service and asking what to buy or sell on a nightly basis, but by getting information to empower yourself with and then making your own choices, okay? So I hope this helped you. I look forward to you purchasing the $37 deal so you can become a student of mine, and I can be corresponding with you in the near future. Thank you so much. I wish you the best of luck trading. I look forward to all of you becoming students of mine. Thank you so much. We'll see you next time. Bye-bye.